Welcome to the Credit Risk Management Advisory Podcast, where we focus on managing asset quality and borrowers during economic downturns. Today's credit risk memo tool is CRE lending risk. At creditrma.com, we help sharpen regulatory credit risk rating and evaluation systems and support a credit culture that respects all internal stakeholders and every commercial loan borrower. We also examine key creditor tools to improve outcomes. Let's dive in. Okay, the main objective for today is, as we discuss CRE valuation risk, is to better understand the general risks of commercial real estate lending, and from a valuation perspective, this includes an appraisal, evaluation, or even a validation. The expected takeaway is to take a closer look at CRE as a potential source of repayment. Spend sufficient time in training into CRE lending risks and view CRE collateral as a potential sole source of repayment during an economic downturn. So you have to really know the collateral property, what that CRE risk is all about. Okay? Appraisal considerations. So some new views, on CRE risks. Starting out with relevant market conditions and the impact on the borrower. Analyze how market conditions during a downturn environment impact CRE borrowers. For example, declining CRE valuations, inflation, increasing interest rates, employment rates, borrowing costs, increasing vacancy rates, decreased lease or rental rates, increasing operating expenses, decreased demand for CRE, lack of available financing, and less economic growth. Determine how these measures affect the borrower's ability to repay. Determine and document how these conditions are impacting the borrower. Next, extraordinary assumptions. Stakeholders, including the appraisal review function, analysts, underwriters, the primary relationship officer, and even credit administrators need to read and understand any noted extraordinary assumptions in a CRE appraisal report. These may include, for example, the following assumptions: that the property is free of zoning violations, structural defects, encroachments, easements, liens, title defects, flood risk, fire hazards, mold, termites, environmental contamination, hazardous materials, asbestos, radon, lead-based paint, sinkholes, soil contamination, water damage, foundation issues, roof leaks, etc. Next up would be hypothetical conditions. Again, the same stakeholders need to read and understand the noted hypothetical conditions, especially these in a CRE appraisal report. For example, these may include the following conditions that the property may or may not be subject to: clear title, legal disputes, pending litigation, zoning changes, environmental conditions or regulations, building code violations, easements, liens, encroachments, leasehold interests, mortgage interests, restrictive covenants, adverse physical conditions, adverse economic conditions, adverse legal conditions, adverse market conditions, adverse political conditions, adverse social conditions, and any adverse technological conditions. Next up, leases and rental rates, vacancy and operating expenses. Review the current rental rates and compare them to market conditions, interest rates, tenant demands, zoning. Analyze vacancy trends over time and its impact on borrower income and the root cause for higher vacancy, whether it's market conditions, tenant demand, the economy, zoning. Anticipate changes to vacancy rates. Observe material operating expense increases as a percentage of gross income and determine the reason for the increase, be it improvement to the property, and to attract tenants and maintain and prevent deterioration, reflects changes in the market, tenant demands, zoning regulations, and so on. Project material changes with supported and documented analysis. Next, cap rates, the ratio of a single year of NOI to the property asset value. In an increase in interest rate environment as capitalization rates increase, analyze the effect caps are having on CRE valuations. In a down economy, the cap rate will increase as stakeholders become more risk adverse, thus making it more difficult to obtain financing, resulting in lower CRE values. Analyze and document how the creditor's exposure on such CRE collateral needs to be handled. Consider additional risks to the creditor and the borrower: market conditions, credit, liquidity, collateral valuation, environmental legal zoning, construction, tenant, management, hypothetical conditions, and extraordinary assumptions in the appraisal report. Next, discount rates, the investor's required rate of return, discounting future cash flows during the holding period back to the present to determine value. In a down economy, the cap and discount rates tend to increase, and both rates share these risks. Other risks include default risk, foreclosure risk, the creditor having to sell the foreclosed property in a down economy. Absorption. Understand the rate at which commercial space is being leased up in the subject marketplace. Review the original appraisal absorption assumption and compare it with the current demand for similar space today in a downturn market. As absorption rates will be lower, properties will take longer to sell, leased at lower prices, require more marketing or incentives such as rent concessions, tenant improvements to attract tenants or buyers. Per a physical inspection, identify any significant repairs. Leasehold interest. Confirm the remaining length of the leasehold interest. Rent escalations for reasonableness. Look for resizing requirements, additional collateral or guarantees if necessary. Do it now before the leasehold interest buries the subject wasting asset altogether, if applicable. Tenant improvements, or TIs. Carefully analyze the TIs financed by the creditor, whether they are cosmetic changes or major structural renovations. Get a resizing if necessary. An appraisal recommendation. For example, do you need a new appraisal or a validation of a prior appraisal or an evaluation? And based on relevant or material changes in market conditions, project performance, geographic conditions, and variances from original appraisal assumptions, change in project specs, loss of lease or takeout, high pre-lease fallout, or as borrower's financial condition deteriorates. Somebody's going to have to make a recommendation. This short ad is sponsored by the Debt Crisis Problem Podcast. Attention listeners, please join us at tunabudget.com to tune in to the Debt Crisis Problem Podcast, where in plain English we discuss the 20 risks that could soon fuel a serious economic downturn. We explore these critical risks and offer practical insights for navigating financial uncertainty. Join us for thought-provoking discussions that encourage transparency and more awareness. Subscribe now to stay informed and be ready for whatever comes next. How about some additional commercial real estate lending considerations? Maybe emerging CRE risks. What are the big ones? Interest rate risk. Higher interest rates result in likely higher borrowing costs, more difficulty for the borrower to repay or obtain replacement financing, and result in a higher likelihood of default and foreclosure. Possible mitigating strategies for managing interest rate risk is using interest rate swaps, exchanging a variable rate for a fixed rate. Interest rates can be capped to limit increases or maximize costs, or have floors that provide a minimum borrowing cost. Next, refinance risk. Certainly, higher interest rates have a material impact on refinance risk. With the increased costs of borrowing, it becomes more difficult for borrowers to refinance, possibly leading to payment default and even collateral liquidation. The property's value may become reduced and make it even more difficult to refinance. Creditors should pay very close attention to the earlier resizing opportunities before refinance risk increases too far, including closely monitoring interest rates and market conditions, borrower creditworthiness, upping guarantees, and taking additional collateral. Determine if outside financing is even possible, if the loan will need to be downgraded, extended with disclosable modification terms, or the collateral even be sold. The borrower may take measures to improve its creditworthiness and the property value, reduce debt levels, increase cash flow, obtain an additional interested guarantor with consideration given, of course, provide more collateral or guarantee percentage, or offer and negotiate a workout loan or modification. Next, resizing opportunities. As a commercial creditor, you can determine if a CRE loan needs to be paid down or resized by considering various factors such as a higher interest rate environment, reduced net operating income due to decreased rents and higher operating expenses, declining economic market conditions, lower debt yield, a weak forecast, poor liquidity, uncertain repayment ability, and so on. Document the case for a resizing opportunity by using repayment tools like debt service coverage ratio, LTV, debt yield, and stressed interest rate sensitivity, and propose and document a resizing paydown recommendation. Put the interest of the creditor first and the borrower second, even with a high deposit borrower. Next, repricing risk, or the possibility a CRE loan may need to be refinanced at a higher interest rate upon maturity. Especially in an economic downturn and high interest rate environment, interest rates should cover cost of funds, loan servicing, probable loss, as well as a reasonable profit margin. Keep the following in mind when a borrower's creditworthiness or income and the collateral property have declined: the borrower's loss of a major client, a supplier, employee, a major contract, customer, or vendor. Next, a physical inspection. Identify potential risk by conducting a thorough physical inspection of the CRE. Start with reviewing the loan documentation, the title, survey, zoning, to learn of potential legal issues. The visual inspection should include the interior and the exterior of the building and the site to document any potential physical or environmental issues to avoid potential liability. Review the borrower's balance sheet, income statement, and property lease agreements, and note any other issues or questions for follow-up and discussion with the borrower. Conduct regular inspections. Remember to not ignore identified issues. Get borrower authorization to conduct inspections, obtain necessary training if you need to while you're on site, and use proper safety precautions and ensure proper supervision. Next, insurance coverage. The type, the amount, timing, claims acceptance, doubt or protracted resolution. Hazard and fire insurance coverage should help protect damage from fires, natural disasters, property general liability, business interruption, equipment breakdown. Review the adequacy of insurance coverage for loans secured by CRE and determine how sufficient it will cover the cost of repairs or replacement in comparison to the actual outstanding loan balance. If the land value is excessive, the cost to replace the damage may be less than the loan balance. Ensure the policy is in force and has not lapsed. For claims, the insurance company will investigate the validity of the claim to confirm the destruction was caused by a covered event. Work with legal counsel if the claim is doubted, or if the claim resolution is expected to be protracted. Next up is environmental risk. A lender inspection, a borrower questionnaire, a base review, phase 1 and 2 reviews. Ensure the creditor conducts sufficient environmental due diligence, including an environmental lender inspection, borrower-completed questionnaire, and obtain Phase 1 environmental site assessments or Phase 2 ESA, if necessary. Review documentation to confirm the borrower's responsibilities with respect to environmental compliance and remediation, considering the use of environmental indemnification agreements to shield the creditor of potential environmental claims. Thank you for joining us today. We covered CRE lending risk, another essential tool for managing asset quality and commercial borrower relationships. We want to hear from you. Submit your own credit risk memo at creditrma.com and share your insights on navigating credit risk, including special risks in commercial lending. If you found today's episode valuable, please subscribe for updates on future podcasts at creditrma.com. Until next time, let's continue to conquer the credit risk challenges. Thanks again.